Hey, and welcome back to another Skag Academy video lesson. In this one, we're going to be talking about trading ranges and schematics. Now, this is going to be a pretty long lesson. We're going to go through a lot of defining terms for the schematics, a lot of important stuff you're going to need going forward. So please take detailed notes on this section. This is going to be very important for all the case studies, examples, and your day-to-day trading, right? So very important lesson. Let's jump right in. We're going to talk about trading ranges, right? So, really quickly, a trading range is created when market begins to form a temporary equilibrium between both supply and demand that puts a stop to the current trend, right? The smart money starts adjusting and leaving a new market footprint, which we're about to explore, right? A market footprint, a schematic that will include either accumulating or distributing the supply that will act as a new cause for a future effect, right? So again, we're going to go through and define everything inside of a schematic. Please take detailed notes and understand we're going to do further case studies, examples, and stuff that will reinforce what we're talking about. So if you guys don't understand it immediately, that's okay. You're definitely not meant to. So schematics, guys, this is what a schematic looks like. This is one of many examples of the various market footprints that smart money will leave behind as they accumulate and distribute out supplies. These examples all include key characteristics that we will use as a guide to follow the true intentions of the smart money and then trade alongside those intentions. So we're going to break down the schematic phase by phase and go over all these little key events and characteristics you see that are marked out. So starting with phase A here is the stopping phase and signals a trading range forming. It contains four main characteristics, the first one being the preliminary support. This is signaled by the first bounce with substantial buying volume. It's not a trading event, it's just an early stopping warning. Then we have the selling climax. This is the first spot that smart money steps in with continued higher volume. Prices typically close higher as a result. And as a result of those higher closes, you get an automatic rally, right? A reactionary high from the demand at the selling climax. This usually acts as a part of the main supply level for the future range, right? So if you look at the little schematic there, you can see, of course, we have a supply or a resistance line, kind of just signaling for the future trading range that there is an area of supply up here. Then we have the secondary test. This is an additional test of the selling climax area on diminishing volume, again confirming that selling action here is coming to an end. Then we move into phase B. Phase B is the build-up phase. Supply and demand battles it out as price tests the top and the bottom of the range several times, as you can see. You will often get these additional supply tests, right? The STs, the volume decreasing each time that it comes down. You may begin to notice some volume divergence as we approach the end of the phase. This is mostly a waiting and watching phase, although trades between the highs and lows can be made if the footprint is on a larger time frame. Again, that is stuff that we will look at in case studies. Then we have phase C. Phase C is going to be your test phase. During this phase, price will trade lower and typically faster than it has been for most of the trading range, right? A lot more volume coming in at this point. It is a last attempt from the smart money to collect supply at a discount price, and this is the spring. Ideally, price will close back inside of the range with a high effort from the sellers. In some cases, price will close down, but on a significantly low effort from the sellers. Both are price to volume divergences that confirm the accumulation period is possibly coming to an end. Again, if that doesn't make sense just by me explaining it, it will make sense when we begin to look at charts and case studies. These tests happen shortly after the spring, right? The test that's over right next to the spring there, and is one of few additional tests on supply. As shown in the schematic, we are looking for a higher low with declining sell volume. Right, so after those sellers try their best to kind of bring price lower, right, it'll automatically kind of close back up into the range, and then we do expect sellers to give it one final test, but we expect them to fail. Right, again, we will be looking at that in depth later. Phase D is the confirmation phase. Once the spring is set, we should begin to see market structure shift on relatively higher volume until we get a sign of strength, which is that SOS there. Now you can see the SOS is also trading above that resistance line. And if you remember, that's the same resistance line from the phase A automatic rally, right? So we're breaking out of the range, and we want to see that on relatively higher volume. So the set sign of strength will be, again, that first push. confirms that the demand is sustainable after the spring, and prices are probable to continue higher. So before and after the sign of strength, you will see a last points of support along the way. These are little corrective moves with continuous declining volume on the sell side. These are also known as like little liquidity grabs, smaller schematics inside of a bigger schematic. Again, all stuff we will take looks at. And then we have a phase E. So phase E is the money or the get paid phase. At this point, we are already in the market. We look to enter within that phase C, phase D environment. At this point, price has already begun to leave the accumulation zone and start the markup phase. This is less a trading phase for us and more of a position management phase. There are no main characteristics here except fresh highs, and then fresh higher lows as well. We also want to see continued effort from the buyers. Sometimes that's not always there. It's kind of just consistent. It doesn't always have to be more, but the point is that the buying action remains more consistent than the selling action. Now, we're going to jump into the distribution events. This is the same but different, right? So the phases are more or less the same thing. There are some key differences in some of them. So make sure you guys take note of that. Don't just assume it's exactly the same. There's going to be a lot of similarities here, but there are some differences. So again, phase A, right? The stopping phase signals a trading range forming, contains four main characteristics, right? The preliminary supply, the wording kind of changes. It goes from support to supply here. We also use a PSY instead of a PS when we're marking it up, just to signify that we are expecting a distribution or are monitoring a distribution. You'll notice that with a few of the tags. Again, this is signaled by the first bounce with substantial selling volume, not a trading event. The buying climax, again, the first spot, smart money steps in with continued high volume. Prices typically close lower as a result. We get that automatic reaction, right? Automatic reaction, a reactionary low from the supply at the buying climax. Again, this usually acts as a part of the main demand level for the future range. And then we have the secondary test. Again, much like the supply test, additional tests to the buying climax area, and again, diminishing volume, confirming that buying action is indeed coming to an end. Right, so pretty much phase A, same thing in reverse. Phase B, again, still the build-up phase. Supply and demand battles it out again. In a distribution phase, just in a distribution phase B, there will be two main characteristics: a sign of weakness, which is something that is different from the accumulation. Right, this is a push below the AR. You will also get additional upthrusts, which we mark as UTs, which are retests again to that buying climax zone on diminishing volume. This is mostly a waiting watching phase, although trades again can be taken between the highs and lows. The main thing with the distribution here is that sign of weakness. We actually expect in distributions for there to be tests below the range before we actually make the full breakout, right? This shows us weakness. This shows us that, price is getting ahead of itself. We want to see this if we're expecting it to fall. Phase C. Phase C, again, the test phase. During this phase, price will trade higher, and again, typically faster than it has been for most of the range. It is a last attempt from the smart money to distribute supply out at a premium price, right, getting the most for the shares as they can. This is known as the upthrust after distribution, a UTAD. And again, ideally, price will close back inside of the range, and then we'll get that test. The UTAD, again, is just a different way to signify a spring. It's just a rewording from the accumulation. And then that test happens shortly after the UTAD, and again is on, again, diminishing buying volume. So as shown in the schematic, we are looking for a lower high with diminishing buy volume, just more divergence. So phase D. Phase D, again, is the confirmation phase, right? So once the upthrust after distribution is set, we should begin to see market structure shift on relatively higher volume until we get an additional sign of weakness, right? So this sign of weakness will push past the previous sign of weakness, right? You want to actually create another low. You don't want it to be higher than the previous sign of weakness. And we want this also to be on higher than previous volumes. We want to see a good commitment from the sellers here. This confirms the supply is sustainable after the UTAD and prices are probable to continue lower. So before and after the sign of strength, you will also see those last points of supply, those LPSYs. These again are those corrective moves of continuing declining volume. and these are usually smaller, more fractal schematics. So phase E, once again, the money phase, the get paid phase. Again, at this point, prices begin to leave the distribution zone, start the markdown phase. This is, again, less of a trading phase. You can find opportunities within here, but at this point, we're more than likely just looking to, manage our positions, manage our trades, and kind of just scale, off or potentially even in more positions. All right, these are what the schematics look side by side. Again, they look very similar. They are the inverse of themselves. There are some key characteristics that are a little bit different. A lot of it has to do with the price to volume divergence, and we will learn more about that in future lessons. So with that being said, guys, this does wrap up this lesson. I know this has a lot more information to kind of write down. Please feel free to review this a few times, ask questions, leave comments, concerns, thoughts in the comments below or in the Discord, and I will see you guys in the next lesson.